Well, hello and welcome to our latest LinkedIn Live event. And it's actually the first in our series of In 15 Minutes webinars. And today's topic is something often overlooked, often misunderstood, and often avoided entirely by accountants. But I think it's something that we can tackle fairly quickly in 15 minutes. And look, for those who've got more than an initial interest, I'm sure we can help after the session. So it's hedge accounting. It's a special accounting treatment that has some very neat benefits to those holding derivatives over year end, but is there more to it? To help us understand this important topic, I'm delighted to be joined once again by Craig Haymaker, dialing in all the way from Minnesota, USA. Craig is a certified public accountant and a risk management executive with more than 16 years of experience working in capital markets. So it's safe to say we're in good hands today. And I'm your host, Harry Mills, founder of Oki Markets, a London-based currency management firm servicing SMEs, multinationals, and private clients. Craig, welcome. It's great to see you again. I know it's quite early where you are, so thanks for joining. This is your second of these live events now, isn't it?
It's my second, Mr. Mills. Thank you again for having me. And it's good to know that I haven't worn out my welcome yet.
Absolutely not. So look, we've only got 12 or so minutes. So let's start with the basics. What is hedge accounting? And before you jump in and give me the answer, at this stage, I'll just say if there's any questions from the audience, please do add them as a comment to the LinkedIn post and we'll do our best to get through to them. So Craig, over to you. What is hedge accounting in 1 minute or so?
Sure. So hedge accounting is preferential accounting treatment, which we'll get more into in a moment, but it really guides the recording in financial reporting of derivatives deemed to be effective hedging tools within the financial statements. So for the nerds in the room, hedge accounting is colloquial for, in UK GAAP, FRS 102, IFRS 9, or in the US, ASC topic 815. And typically, especially when we're referring to currencies, the most frequent types that you'll hear of when it comes to hedge accounting are cash flow hedge accounting. So think of exposure to foreign currencies and expenses, revenues, and locking in an exchange rate. Fair value hedge accounting, which relates to, say a fixed income bond denominated in a foreign currency whose fair value changes are attributable to changes in currency rates. And then a net investment hedge. Oftentimes these relate to multinational companies repatriating dividends, those with subsidiaries whose functional currency differs from that of a parent company. Those are kind of the more frequent types of hedge accounting that you'll hear about.
Okay, and you mentioned it's preferential, so it's not something that we have to do, but who should use hedge accounting? So that's a good intro to what it is, but who should be doing it? Who should be thinking on this call today, maybe this is something I should look into?
Sure. Well, I would say the most straightforward answer is really any company using derivatives most certainly should use hedge accounting. Who are those? Multinational entities, of course, when we think about those with meaningful currency risk exposure. It really does depend on volume, significance, transactions, the concept of materiality, which, when I was coming up through the audit world, a material change was any change that could change, that could alter my perception of a company in terms of their financial performance, right? So it's a little bit eye of the beholder. But, I think this is something that we can discuss a little bit more of in terms of what does exposure really look like, but maybe that's for later on.
Yeah, maybe that's for beyond this initial 15 minutes. So
Indeed.
I mentioned in my intro, it's often useful for those who are holding derivatives over year end, but is there more to it? So what are the main benefits? Why would someone consider taking this? What is preferential, this special treatment for derivatives? What
Yeah.
are the benefits?
No, it's a good question. Let's start first with what accountants really think about and care about when it comes to derivatives, right? So breaking down two component pieces that correspond to most any derivative position, which is eventual cash flow settlement, and then the intervening mark to market changes in gain or loss associated with holding the derivative position, right? You could call it revaluation, remeasurement as you move from accounting period to accounting period. Okay. So benefit, the preferential piece, really comes into the net effect or impact of accounting for these derivatives.
Mhm.
So the first piece is timing, right?
Okay.
How do we time a loss associated with some currency exposure? And when I say the loss, I mean when it's actually reflected in the P&L, to offset with the corresponding gain that you get from the derivative in that same period, right? So oftentimes I'm thinking about currency exposure. Let's say I'm hedging cost to sale, right?
Yep.
I'm buying widgets or raw materials in rupees. My functional currency is euro or sterling, and I'm looking out across a year. I've got monthly outgoing payments in rupees, and I'm buying out or I'm going long on hedging positions, right? Call them forwards on a monthly basis throughout. Well, for that January reporting period, right, I'll have realized some gain or loss associated with changing rupee, right, in terms of exchange rate, euro to rupee. Um, but I will have 12 months worth of gain
Okay.
or loss associated with all of those derivative positions that I need to record today, unless I elect hedge accounting. With hedge accounting, I can just take that single month's worth of offset and apply it to that same period.
Right.
So, in that sense, I can achieve that offset timing that I'm so desiring in that period and therefore realize a more stable earnings outcome.
So
Okay.
stability is the word, and is it a case of, because it's December now, so we're coming up to a lot of companies' year ends now, or maybe in April. I suppose, is it that one moment in time when you revalue everything? And when you say derivatives, you mean forwards and options as well, right? And any swap
Forwards,
strategies.
options, right, right. Really, virtually any derivative instrument or hedging instrument. Yeah,
Okay, understood.
yeah,
So those are the benefits. That's stability, that's smoothing, and avoiding that one big mark-to-market profit or loss.
right.
What are the costs associated? Because people have, as I said earlier, people avoid doing this, right? Because it's seen as a bit of a pain. So
Yeah,
what are the costs? And let's be honest for everyone on the call.
yeah, yeah. No, for sure. So again, it's a function of the nature of the business and the extent and volume of your currency exposure of your hedging needs. Now, having said that, I think for most companies, I'm speaking mostly to I think the mid-market companies. You can expect a hard dollar cost of maybe somewhere between 20K to 100K a year. I know those are pretty wide bookends depending upon the entity and how sensitive you are to those costs. But for other companies whose internal staff are savvy and have an expertise or at least a willingness to pick it up, I mean, we're probably talking about 5 to 10 hours a month in
Okay.
terms of soft dollar costs. Now, there's a ramp up, right? I mean, there's a pretty steep learning curve, and it can take time for companies to get off the ground. But if it's taking much more than that for what I'd say is a modest portfolio, call it 5 to 30 hedging instruments, if it's taking longer than that, we should talk because there are ways to sort of optimize and scale this work. And it really has never been easier to achieve hedge accounting than it is today.
Okay, understood. And you mentioned the hard dollar cost and the soft dollar cost there, so time and money.
Yep.
Is it hard to do this? Do we need to take on special software, special consultants? Could I do it? Would my FD be able to do it? What do you think? Is it a hard process to actually go through and to do?
Yeah, I mean, it can be challenging. So much of it, and we like to think about it as learning a new language, right? Maybe you're fluent in Italian, but hedge accounting is this sort of, countryside dialect of Portuguese, right?
Yeah.
It's a different language entirely. Even for accountants, that might be very technical with revenue recognition or lease accounting. When they transition to hedge accounting, it can be, there's that steep learning curve. And again, I think a lot of it is it really straddles finance, and it can involve statistics from time to time, and so straddling those two areas can be challenging for accountants. They don't love to dabble into really deep, heavy finance, and
Yeah.
financiers don't love to get into the debits and credits. So I think that's why it can be challenging for many companies. But again, like anything else, you spend time with it, you learn it, and you're able to pick it up. I'll tell you, a lot of it really truly comes down to documentation.
Because you mentioned hedge effectiveness. This is a term
Yeah.
that I've heard banded around.
Yep.
Is that something that we need to be able to document and evidence correctly and
The
sufficiently?
doc The documentation is everything. We call that the blueprint or the guiding light. And when auditors and regulators come in the room and you say, "Hey, I have a hedging program, and oh, by the way, I'm doing hedge accounting," that documentation or hedge designation memorandum, as we nerds refer to it, that's going to be among the first things that they request. And really, when we talk about hedge effectiveness, especially in international GAAP or IFRS, that piece of documentation has all but taken the place of what historically has been a need for statistical analysis or proving correlation in hedge effectiveness. Now it's effectively a documentation exercise to show the economic relationship, the effect of credit risk on the effectiveness of the hedge, and then also proving and showing what the anticipated hedge ratio is expected to be. If you can document all those things, then you can convey qualitatively that the hedge is expected to be effective.
Okay, and going slightly off script, we've got a couple of minutes left. Thinking about the hedge effectiveness, and you mentioned earlier, if you were a firm, maybe it's a UK firm or a European firm, and you're buying widgets from India, I think that's what you said, or maybe from China.
Yeah.
So we've got a sterling rupee or sterling dollar or
Yeah.
euro rupee, euro dollar kind of exposure. If it's just cash flow hedging, paying for widgets picked up every month next year, 2024, January through December, surely I can demonstrate the effectiveness and that correlation quite easily, right? Or is there more to it than this?
No. Absolutely. And then it just comes down to that documentation exercise in terms of properly and comprehensively, documenting the nature of that hedge relationship and what your risk management objective truly is. And especially with FX forwards. And I know that you're a preacher of simpler derivatives, moving away from complex derivatives. Well, as you can appreciate, the more complex the derivative, the more challenging it can be to prove the effectiveness and to document it appropriately.
Okay, understood. So that's a good summary of what hedge accounting is. It's preferential. It's all about that correlation and proving effectiveness and the documentation. We've talked about the costs a little bit. It sounds like it's something that's kind of hard, but actually might be easy to get into. So how does someone get started? If someone's on this call right now and they think this could solve a problem for me because I've got a big year-end FX P&L, how do you actually get started with this? What are the first steps to take?
Yeah, I mean, I think doing some initial reading, no one ever loves to hear this, but the big accounting firms, they call them the big four, big five, big six, and the super regionals, offer really nice summary level documentation related to what it takes, what it means, things to think about. To the extent you really want to make that leap faster, engage consultants. The risk management space is a bit of a cottage industry. There are those of us sprinkled throughout the world, but are more than happy to dive into the details and provide a detailed outline in terms of what's necessary to move forward.
Awesome. And you'd be available, Craig, would you, to answer any questions that we've got after the call?
Happy to.
Wonderful. Well, there it is. That's Hedge Accounting, an introduction in 15 minutes. It's just coming up for time to close. So thanks for everyone attending. Craig, thank you for your expert insights. Hopefully everyone found it useful. If you have any follow-up questions, you can add a comment to the post. You can reach out to me on LinkedIn or by emailing me, harry@archimarkets.com. Our next webinar is actually on Tuesday, the 12th. This one you won't want to miss. It's our 2024 Market Outlook. And this is with special guests, Michael Brown, David Bell, and Paul Plewman. So register now, reserve your spot, and don't miss it. Craig, thanks again. I really appreciate it. This is a hot topic, so really appreciate your insights.
A lot of fun. Thank you, Harry.
All right. Thanks a lot. Thanks for joining. Take care.
Cheers.